I walked into a bank back in 2006 and asked what I needed to get a $500,000 mortgage. The loan officer checked my pulse, handed me a pen, and asked if my dog wanted a condo too. But seriously, welcome back to the Granite Vault. In September of 2008, a 158-year-old financial empire vaporized overnight. $600 billion gone. Retirement accounts were incinerated. Millions of jobs vanished into the digital ether. But history books tell you this was a tragic economic accident. That is a lie. The 2008 collapse wasn't a mistake. It was a perfectly architected wealth transfer, disguised as the American dream. And it was all built on a slogan so simple, it fit on a billboard. Why rent when you can own? Today, I am going to show you the hidden machinery of the greatest financial heist in modern history. We are going to look at the toxic data, the invisible insurance bets, and the exact moment the government decided to socialize the losses while privatizing the profits. Because if you don't understand how they rigged the game in 2008, you won't survive the algorithm they are building for 2026. Let's dig in. To understand the crash, you have to look at the bait. After the dot-com bubble burst and the towers fell in 2001, the Federal Reserve panicked. According to historical Fed data, they slashed interest rates from 6.5% down to 1% in just 2 years. Suddenly, money wasn't just cheap, it was practically free. But here's the insight most documentaries miss. When a central bank makes money free, they aren't trying to help you buy a house. They're trying to force you to take on debt to keep the machine running. Enter the ninja loan. No income, no job, no assets. You make $40,000 a year? Here's a $500,000 adjustable rate mortgage. The banks didn't care if you could pay it back because they had zero intention of holding onto your loan. The strategy was simple. Write the paper, collect the commission, and pass the grenade to the next guy. I knew a guy who bought 3 houses with 0 down while working part-time at a coffee shop. He told me he was a real estate tycoon. I told him he was a barista with $1 million in unsecured debt. He didn't laugh, neither did the banks, because the banks had a magic trick. Wall Street realized they had a massive problem. They were sitting on millions of garbage mortgages. So they took thousands of these toxic loans and blended them together into a massive digital smoothie called a mortgage-backed security. Then, they took the absolute worst of the worst and repackaged them again into a CDO, a collateralized debt obligation. But here is the mechanism the media never explains. This wasn't about spreading risk, it was about laundering it. When you mix toxic debt with good debt, the algorithm hides the rot. And the terrifying part? Wall Street is using this exact same blending mechanism today. Not with mortgages, but with auto loans and credit card debt. But how do you sell a smoothie made of financial garbage to global investors? You pay the health inspector to lie. Wall Street went to the credit rating agencies, institutions like Moody's and Standard & Poor's, and paid them to stamp these toxic bundles with a shiny gold AAA rating. According to the Financial Crisis Inquiry Commission, the rating agencies gave top grades to tens of thousands of toxic securities. Why? Because if they didn't, the banks would just take their business to a competitor. This is where the entire system broke. The referees were being paid by the players. If you learn nothing else from this vault, learn this. Never trust a rating if the rater is getting a cut of the deal. With that AAA stamp, pension funds, foreign governments, and retirees bought these toxic bombs. A few rogue analysts looked at the data and realized the entire housing market was a mathematical impossibility. It was a giant, fragile Jenga tower of debt. They wanted to bet against it. So, Wall Street invented one, the credit default swap. It was essentially a fire insurance policy on the housing market. But here is the insane part. You didn't have to own the house to buy the insurance. It was like buying a massive life insurance policy on your neighbor's grandmother and then actively rooting for her to fall down the stairs. By the end of 2007, the CDS market had swelled to over $60 trillion, an invisible casino operating entirely in the shadows. And this is the modern parallel you need to watch. Today, synthetic derivatives and algorithmic flash trading allow institutions to place trillions of dollars in bets on assets they don't even own. The fuse was lit. Then, the introductory rates on those ninja loans expired, and the mortgage payments doubled. Suddenly, the barista couldn't pay. The tycoon defaulted. The subprime blocks were pulled. The AAA-rated toxic waste exploded. And Wall Street realized they didn't just sell fire insurance on a burning building. They were trapped inside it. In September 2008, Lehman Brothers was vaporized. The credit markets froze. The global economy entered a severe financial crisis, and for millions of people, it felt like everything stopped overnight. Main Street lost 8 million jobs and $19 trillion in household wealth. So, what did the government do? Did they let the free market clear the rot? No. They printed $700 billion of taxpayer money and handed it directly to the banks that lit the fire. Many analysts now view this as one of the largest wealth transfers in modern history. Privatized profits for the elites and socialized losses for the working class. The executives kept their multi-million-dollar bonuses, while families were handed eviction notices. If 2008 taught us anything, it is that the system will never save you. When the banks fail, they get a bailout. When you fail, you get liquidated. So here is your granite protocol for the next crisis. Number 1, if an asset requires zero effort to acquire, you aren't the buyer, you are the product. Number 2, read the fine print. When the media says money is cheap, it means the trap is set. Number 3, build your own vault. Hard assets and low leverage. Practically, that means paying off your high-interest debt, keeping cash liquidity, and never investing in algorithms you do not understand. The next crisis won't look exactly like 2008. What is different today isn't the system, it is the speed. It will be digital, it will be algorithmic, and it will happen overnight. Protect your keys. Build your cathedral. Stay solid.